Stock trading for beginners. Before we get started, subscribe to our channel and turn on the notification bell so you never miss our latest content. Understanding what stock trading is. Stock trading is the act of buying and selling shares of publicly listed companies through a stock exchange or brokerage platform. When you buy a stock, you're purchasing a small piece of ownership in that company. Stock prices fluctuate based on a variety of factors like company performance, investor sentiment, economic indicators, and global events. As a trader, your goal is to capitalize on these price changes, buying low and selling high. Unlike long-term investing, trading often involves shorter holding periods. It's important to distinguish between trading and investing. Traders seek to profit from short-term movements, while investors aim for long-term gains through compound growth and dividends. Learning the basics of how the market works is crucial before placing your first trade. Types of stock traders. There are several types of stock traders, each defined by the duration and frequency of their trades. Day traders buy and sell stocks within the same trading day, aiming to profit from short-term price fluctuations. Swing traders hold positions for several days or weeks to capture trends. Position traders, meanwhile, may hold stocks for months, similar to investors, but their intent is still profit from large trends. Then there are scalpers, who execute dozens of trades a day for tiny profits. Choosing the right trading style depends on your risk tolerance, time availability, capital, and personality. Each type of trading requires different tools, strategies, and levels of market knowledge. Beginners should start by understanding these styles before deciding which suits them best. Opening a brokerage account. Before you can start trading stocks, you need to open a brokerage account. A broker acts as the middleman between you and the stock exchange. Today, most brokers offer online platforms that provide research tools, charts, and trading interfaces. You can choose from full-service brokers, which offer personalized advice and portfolio management, or discount brokers that provide a DIY experience with lower fees. As a beginner, it's best to start with a user-friendly platform that offers educational resources. When selecting a broker, consider fees, ease of use, available tools, and customer support. Many platforms also offer demo accounts where you can practice trading without risking real money. This is ideal for getting comfortable with market orders and trading mechanics. Learning key market concepts. Before placing trades, it's essential to understand foundational market concepts. Terms like bid price, ask price, spread, market order, limit order, stop loss, and volume are crucial. For instance, a market order buys at the current price, while a limit order sets the price you're willing to pay. Understanding how stock charts work, including candlestick patterns, moving averages, and trend lines, will help you analyze potential trades. Additionally, learning about market indices like the S&P 500 or Nasdaq gives context to stock performance. Economic indicators such as interest rates, inflation, and GDP also influence stock prices. The more fluent you are in these terms, the more confident and accurate your trading decisions will be. Technical versus fundamental analysis. There are two primary ways to analyze stocks: technical analysis and fundamental analysis. Technical analysis involves studying price charts, volume, and patterns to predict future movements. It's commonly used by traders who focus on short-term price action. Fundamental analysis, on the other hand, evaluates a company's financial health, earnings, management, industry position, and macroeconomic conditions to assess its long-term value. Beginners should understand both methods to decide which suits their trading strategy. Many traders use a combination of both, technical analysis for timing entry and exits, and fundamental analysis to determine what to trade. Learning how to read balance sheets, income statements, and technical indicators will drastically improve your decision-making process. Risk management strategies. Managing risk is one of the most important aspects of trading. Even skilled traders experience losses, so it's vital to have a plan to minimize damage. Common strategies include using stop-loss orders to automatically exit trades when they hit a certain loss level, and limiting the amount you risk on any single trade to a small percentage of your capital, often 1 to 2%. Diversification, avoiding over-leverage, and maintaining a consistent strategy are also crucial. Emotional control is another form of risk management. Fear and greed can lead to irrational decisions. Stick to your trading plan, don't chase losses, and always evaluate the risk-reward ratio before entering a trade. Developing a trading plan. A trading plan is a written document outlining your trading strategy, rules, goals, and risk tolerance. It defines when to enter and exit trades, how much capital to risk, and what assets to trade. Without a plan, trading becomes emotional and inconsistent. Your plan should be based on tested strategies, whether they are technical, fundamental, or a hybrid. It should include criteria for trade setups, stop-loss placements, position sizing, and performance evaluation. New traders often skip this step and act on impulse, which can lead to losses. A solid plan provides structure, prevents overtrading, and keeps you aligned with your long-term goals. Understanding market psychology. The stock market is influenced not only by logic and data but also by human psychology. Fear, greed, overconfidence, and panic drive market trends just as much as earnings reports or economic news. Understanding market sentiment, how other traders are feeling, can give you an edge. Learning concepts like herd behavior, confirmation bias, and FOMO, fear of missing out, helps you avoid common psychological traps. It's also important to monitor your own emotions. Do you panic when a trade goes against you? Do you hold onto losing positions hoping they'll recover? Being self-aware and emotionally disciplined separates successful traders from the rest. Continuous learning and improvement. Stock trading is not something you master overnight. Markets evolve, strategies change, and even professionals continue learning throughout their careers. Stay updated by reading financial news, joining trading communities, and following experienced traders. Analyze your past trades, both wins and losses, to identify patterns and improve. Keeping a trading journal can be immensely helpful in tracking your decision-making and refining your strategy. Take online courses, attend webinars, or read books to expand your knowledge. The most successful traders are those who remain students of the market, adapt to new conditions, and never stop seeking ways to improve. Starting your journey in stock trading can be exciting and overwhelming, but with the right knowledge, discipline, and tools, it can also be rewarding. Take your time to learn, practice, and build a strategy that works for you. Remember, consistency beats intensity, and education is your best investment. If you enjoyed this video, give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. Thank you for watching.